Joining us now is Rosenberg Research founder and president David Rosenberg. David, I really wanted to talk to you because I was just curious if you were maintaining the bearish recession call as it has just not materialized.
It hasn't materialized, yet. You know, it's, I'm talking to you here from Toronto, and it's as if it doesn't snow in December, then we'll just call off winter. There are lags that we all know, long and variable policy lags. And the reality is that when you look historically, from the time of the first rate hike by the Fed to the time the recession starts, is typically 2 years. So I think that maybe the people that were jumping the gun calling for recession this year were just basically a little too impatient. Reminds me of the recession calls I was making in 2007. That was a very long, soft landing, but the recession started December of 2007. So I think we just have to basically acknowledge that this year the economy did better than expected for two reasons, Sarah. We had the lingering impact of the fiscal stimulus, and we had a consumer credit card boom. Those are not recurring. So it's going to be interesting to see, with the credit card issuance coming down and fiscal tailwinds moving to headwinds, how the consumer is going to be responding starting in the fourth quarter. So the fourth quarter is going to be a litmus test for my call, absolutely.
I'm not sure if the fiscal stimulus, though, reverses. I know what you mean on the consumer side and the excess savings coming down, but we're also ramping up on infrastructure spending and the CHIPS Act and the Inflation Reduction Act. And some folks, you know, one of the prevailing views here is that all of that money is going to come in next year and offset a potential recession.
No, I don't think that's going to happen. I think that when you're taking a look at the fiscal deficit, the GDP ratio, the big stimulus was actually this year. The incremental impact on growth was this year, not next year. And I don't know why you would be comparing industrial subsidies in the business, which is a relatively small share of GDP, to the impact of the consumer sector, which is 70% of GDP. You can't compare the two. The key is not how the CHIPS Act or all these other industrial subsidies, government intervention is going to influence the business cycle. The key is going to be what happens to the consumer now that these fiscal training wheels are off. We just don't know, Sarah, how is the consumer going to respond, not just to the impact of energy prices. I don't look at this as something permanent, but the lagged impact of the rate hikes, I think, are being underestimated by the Fed and by most of the people you interview from Wall Street. And I think that the shift from fiscal tailwinds to headwinds for the consumer, which is 70% of GDP, Sarah, what you're focusing on in the business sector is a small share of GDP. It's a small contribution, but I think the overwhelming impact is going to be the pullback that we'll see in the consumer sector over the course of the next several months.
That said, David, I mean, we're still having conversations about real hourly wages inflecting positive, disposable income on the rise. The share of disposable income that goes to gasoline is really kind of moderate. We had Rich Bernstein on yesterday talking about the pay and trade being about a reacceleration in macro data. I wonder what kind of debate you and he would be having if you were back in your old chairs.
Well, where's the reacceleration? I mean, we just got housing starts for the month of August. They were down 11%. We got new home sales. What was that? Yesterday, down 9%. Existing home sales were down. In inflation-adjusted terms, in August, retail sales were down. Actually, in August, real disposable income was down. So I'm not getting that sign of economic reacceleration unless your only metric is the Atlanta Fed's nowcast model. Everything else is showing that the economy is actually trudging along somewhere close to a 2% annual rate. But don't forget, we've been breathing fumes of the lingering impact of the fiscal stimulus all year long. That's coming to an end right now. So I don't know where the reacceleration is coming from, unless you believe somehow that interest rates don't matter.
It's just
and if you believe that policy lags don't exist.